But let's understand where the market is headed from someone who tracks the broader universe rather closely. Vinit Sambre, Head Equities at DSP Mutual Fund, joins us on the show right now. Vinit, hi, morning. Day in and day out, we discuss in the studio as to why practically when the index is still hovering around the all-time highs, we're still lingering around 12K. Broader markets haven't shown the excitement. Within Nifty, it's been very selective names. And I guess that's why you don't have all that cheer and fervor around an all-time high.
Yeah, I think you're right. The broader market actually is showcasing the true reflection of what's happening in the economy today. As we see, we are all aware that most of the macroeconomic indicators are not showing great signals, and it is the broader segments which are really reflecting that today. And we have seen massive polarization where the top 15 stocks, let's say, are carrying the bulk of the responsibility of heavy lifting the Nifty towards the high.
On the mid-cap end of the market, Vinit, I mean, what we've seen is a meager rebound, really, just about 15% and off an up move really coming in from their all-time lows. How long before we see a more broader and meaningful recovery come back?
I think, as I said, for the broader recovery to come back, we clearly believe that most of the macroeconomic indicators, the growth for the corporate India needs to broaden, it needs to improve, the sentiment needs to improve, the liquidity in the system has to be better here. We need to see private investment capex picking up, which will also mean that there will be improved job scenario in India, and I think all those factors is what is going to lead to the the broader segments doing well over the longer term. But in the meanwhile, because these categories are subdued and we understand that cycles do not last forever, this is also good time to be selective, to identify companies where we believe they have business strength, they have capital efficiency, they are run by good management, and I think those are the pockets which we are trying to identify as an opportunity in these tough period.
Okay, Vinit, I'm taking a look at some of your holdings and your picks, and want to understand. I mean, it looks like you've been very selective in the kind of mid caps that you've chosen to go for. Is there a theme that you're still more bullish on, for example, consumption, or are you going by, very selectively, in terms of looking at companies and their potential for growth? What are you looking at?
It is, it is really a very bottom-up approach which we have been following, and we try to look for common factors across different companies, different sectors, and these common principles actually they actually have been looking at businesses, looking at durability of businesses, looking at the long-term picture, looking at companies which are run by good management, and clearly trying to avoid businesses where we see governance standards not being up to the mark. And this thankfully for the last 1.5 years, while we have seen so many companies just fall off the cliff because of the governance standards, this has actually helped us in terms of being very selective in the types of company we own in the portfolio. Now, within these broader framework, within these factors, we try to look for segments or sectors which we believe have long run, we believe have good potential for the next foreseeable future, and not try to really chase the next quarter's earnings. So I think that has been the differentiator as far as the stock selection exercise is concerned. And by and large, you asked me about the segments. I think clearly we when we think of the long-term opportunity, the segments within the consumer discretionary, the segments within the healthcare, IT, I mean those the financial sector, those are typically the ones where we believe the long-term opportunities still persist, and we will continue to look for opportunities within those.
Vinit, just wanted to understand your outlook as to when is the opportune time to pick in, because we have seen the mid-cap index underperform the frontliners. The long-term returns, though, do seem to be quite similar. But given the fact that historically we've seen the mid-caps do well in periods of good economic growth, it's a bit difficult to make a strong case. So at a time when we're seeing a little bit of consolidation play out, what is your view as to when is the opportune time to enter into the mid-caps?
See, clearly from the investor's viewpoint, the good time to enter the equity as a category is a time when we are actually seeing a lot of pressure in the economy. The growth is challenged, and which is what is the scenario right now. And in a way, then the bigger issue is when will the recovery start, because as soon as one gets the clue about the recovery, I don't think the stock prices are going to be here where they are today. So in a way, for the long-term investors, this is surely a good point, and probably as till the time we do not see recovery, or till the time the earnings keep disappointing, probably the returns may not come through. But I think equity investment is all about the waiting game. One has to look for opportunities in troubled times and wait for the time to change, or wait for the cycles to move to start moving up, and that's how one should look at equities from the long-term view.
Vinit, just want to look at some of the individual segments as well. And in your declared fund portfolio, I see a lot of chemical in there. What is the opportunity from this China substitution story? And are there any individual chemical stories that particularly interest you? Because the segment in itself is pretty diversified and varied.
Yeah, you're right. It's a very diversified segment, and what we have chosen to stick with for the last 7-8 years have been clearly the specialty chemical companies, which have actually seen different cycles in the past and have emerged really very strong. So irrespective of the fact that China is in the last 1.5 year giving more opportunities, I think most of the companies have anyways stood the test of time, and China has come as a, I would say, bonus, where these companies are seeing increased level of inquiries from the global customers. So clearly the focus has been to be with the specialty type of chemical companies, and we believe, like you said, the China opportunity is going to be incremental and going to add to their earnings momentum in the near future.
Just going through the portfolio changes as well, Vinit, and you've gone ahead and offloaded the RBL Bank stake and added Dabur to the portfolio. Can you elaborate a little bit more as to how you've read into the recent news flow with RBL Bank and what is making Dabur such a compelling buy?
I would refrain from talking about stocks, but let me give you a very broad perspective as to when we have spoken about this even in the past. When we look at the financial companies in the portfolio, we really like the banks or NBFCs which have good proven track record of decent growth, but more importantly the focus is on the quality of assets. And if we have any view around the quality of assets deteriorating or any of those risks emerging in the near term, we have taken a call to sort of rationalize the companies there. And I think some of the portfolio actions to add or to knock off actually depends upon these factors slipping from their standards, and that's where I can say that those had taken place. In terms of the consumer as a category, we believe that this is a category which has a which has a long play in India. There's a the trends are going to look better for within consumer. Let's say if it is a Ayurvedic based business, I think it is picking up momentum, and which is where we are trying to look for opportunities. While I have said in the past that the FMCG businesses are looking expensive, and the only way one can look to buy some of these expensive stuff is to have a longer waiting period, because 3 years down the line, I think some of these businesses, as they continue to grow, the valuations will start looking reasonable. So I think we are trying to find pockets of opportunities where durability, where the competency of the business is not an issue, where the capital efficiency is very high. So I think within those broader framework, I think these stock fit within our thought process.
Okay, fair enough. I know you said you're taking the bottom-up approach, Vinit. Given that, we've seen quite a battering across the board when it comes to the broader markets. I just want to understand the return potential on some of the names that you're looking at. Was there an average? Is there actually a potential on some of the beaten-down names, as you see it, for maybe not multi-bagger, but double-digit returns for sure?
Yeah, in fact, the last time when I was here, I spoke about the auto ancillary, which were actually quite beaten down, and 1 month of good festival sales number actually has seen many of these stocks doing well in the last 15-20 days. So I mean, clearly this is a market where such opportunities will be presented if one is clearly focusing on some of the category leaders, and there may be categories which are going through low cycle today. The case is evident, like I said, in auto ancillary, but also we see within the building materials as a category, they are going through low cycle today. Even software, for that matter, is not really low cycle, but they are clearly trading at a attractive level of valuation. So what we try and seek is within the categories which we believe are not facing structural problems, and we see these slowdown as transitionary in nature. We try to seek, or we try to look for the leaders within those category, and try to look for opportunities there. So I think such kind of markets today definitely is giving out these opportunities, and which we are trying to look for.
Just in terms of the companies that you have seen a decrease in weightage in, particularly from the mid caps, I know you've spoken about sectors that you like, such as specialty chemicals, financials, etc. Is there any specific sphere that you're avoiding?
What we have seen, because of lack of growth and private investment taking place, some of the segments which are linked to the capex side of the economy, I think those have not been doing well over the past few years. We keep calibrating our weights in some of these segments, while we understand that at some point as the investment really picks up, some of these companies will start doing well, but we haven't seen that happening for a while now.
Okay, what about some of the pockets, for example, some of the metal names or ancillaries or some of the cyclicals? Do you really see potential there, Vinit?
It's very difficult to take a guess, because these are global commodities, and the variables to track tend to become really it's very difficult to project as to how these demand is going to shift globally. So but by and large, the way to look at some of these segments which are long cycle businesses is that when they come off in terms of the valuation. They come off below the book. That's a time to look at these companies. And when the cycle turns, that's where the upside can come through. But going by what's happening globally, we are talking about global slowdown, many economies staring at recession. It's very difficult to see a immediate turnaround in some of these long cycle commodities.
Would that hold true for cement as well, Vinit?
Cement, I would not categorize in the same bucket, because I believe cement is more domestic oriented, and we believe the domestic long-term story is still intact. I mean, we in the past also we have seen our economy go through such phase. We have seen fiscal deficits much higher than where we are today. But we have rebounded back as economy, given the sheer size of opportunity, level of urbanization which is taking place. There's a shift which is happening in terms of the consumer trends as well. So we believe that India still definitely have long-term future and opportunity, and cement is going to be the key material which is going to be required for nation building, and there we tend to have a relatively positive view.
Thanks for joining us then this morning, Vinit.